Welcome back to the channel. Today we're diving deep into one of the most talked about dividend ETFs on the market, SCHD. If you've been tracking ETFs, you know SCHD has had its ups and downs. 2025 was far from kind to this fund, leaving investors scratching their heads while other dividend-focused ETFs were soaring. But here's the thing, 2026 might just be the year that SCHD begins a serious comeback. So in this video, we're going to break down what happened in 2025, why SCHD lagged behind its peers, what's driving its early 2026 performance, and what investors need to watch for in the coming months, especially with the upcoming March reconstitution. And of course, we'll discuss who this ETF is really for and who might want to stay away. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the hard truth. Last year was rough for SCHD, no sugarcoating it. Over the course of 2025, SCHD delivered total returns of just 4.3%. Now, that might sound okay at first glance, but when you compare it to other dividend-focused ETFs like VYM, which returned 15.4%, or VIG with 14%, you realize SCHD wasn't just slightly behind. It was way behind. This underperformance wasn't random. There were several key factors that worked against SCHD, and before diving into them, it's important to note one event that set the stage: the fund's March 2025 reconstitution. This was a major reshuffling of its holdings, with notable sector adjustments. The biggest change? SCHD nearly doubled its energy exposure, moving from 12% to 21% of the portfolio. At the same time, consumer staples were added, financials were trimmed by roughly 9%, and healthcare saw some adjustments as well. These changes were significant, and they would intersect with a series of market events that made 2025 a tough year. The first factor behind SCHD's disappointing 2025 performance was an event I like to call Liberation Day, which occurred just days after the reconstitution. On April 2, 2025, President Trump announced new tariffs, sparking a broad market sell-off. SCHD, with its newly increased energy weighting, was hit hard. Energy stocks tend to be highly sensitive to geopolitical and trade-related uncertainty. Defensive sectors within SCHD, like consumer staples and certain healthcare stocks, weren't able to offset the losses. Growth-oriented stocks outside of SCHD, especially in tech, rebounded much faster, leaving SCHD lagging in the process. The second factor is more straightforward. SCHD doesn't invest in the big tech giants, sometimes called the Mag 7, like Nvidia, Google, Amazon, and others. Over the past several years, these companies have been key drivers of market returns, particularly during the tech rally. While the tech sector was soaring, SCHD was largely on the sidelines, missing out on one of the biggest engines of market growth. Even sectors that traditionally provide stability, like consumer staples, struggled to attract investor interest, as the market had a strong preference for high-growth tech and AI-driven stocks in 2025. The third factor was SCHD's exposure to energy, which didn't pan out as expected. After doubling its energy allocation during the March 2025 reconstitution, the sector faced headwinds. Oil prices fell significantly over the year as supply outpaced demand, and the looming threat of further tariffs added another layer of uncertainty. Energy had the potential to be a strong contributor, but instead it became a drag on performance. When you combine this with consumer staples underperforming and the lack of tech exposure, it's clear why SCHD lagged behind other dividend ETFs. Fast forward to 2026, and SCHD is already showing signs of life. As of this recording, the fund is up 14.7% year-to-date, which is remarkable given that we're only a little over a month into the year. If we look back at late 2025, SCHD had around 20% returns, suggesting that the fund may be positioning itself for a strong recovery. So what's driving this turnaround? There are a few key factors. Investors are shifting away from high-risk assets and speculative tech stocks, particularly after a rapid run-up in AI and software sectors. When stock prices climb too far based on projected future growth, any hint of disappointment can trigger sell-offs. Recent inflow and outflow data show that ETFs focused on tech, like XLK, have seen significant outflows, while SCHD has experienced increased inflows. This doesn't mean all funds are moving directly into SCHD, but there is a clear rotation towards safer, more value-oriented, and defensive assets, which benefits the fund. Unlike 2025, the energy sector has been performing exceptionally well in early 2026, with returns near 17%. Given that energy represents roughly 20% of SCHD's holdings, this sector alone is driving meaningful growth. Consumer staples are also performing well, further contributing to the fund's resurgence. SCHD undergoes a reconstitution every March, and this event can either boost or limit the fund's performance for the rest of the year. The fund tracks the Dow Jones U.S. Dividend 100 Index, which applies strict criteria for selecting dividend-paying companies, a minimum of 10 consecutive years of dividend payments, market cap of at least $500 million, and minimum average trading volume of $2 million. Companies are ranked by indicated dividend yield, and the top 50% are eligible for selection. A composite score based on free cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate determines the final 100 stocks in the index. No single stock can exceed 4% of the index, and no sector can surpass 25%. What changes might we see in March 2026? Based on early trends, it's possible energy exposure could be trimmed if recent gains persist and yields decrease. Consumer staples might also be adjusted, while sectors like healthcare, telecommunications, or select aerospace and defense stocks may be added. Several factors could work in SCHD's favor this year. Tech weakness. If AI spending and tech valuations disappoint, funds may rotate into safer, dividend-focused ETFs. Value rotation. As growth stocks become more expensive relative to value stocks, investors may pivot toward funds like SCHD. Fed rate cuts. Historically, dividend-paying companies outperform during periods of falling interest rates, attracting investors seeking income with lower risk. No fund is immune to challenges, and SCHD faces some potential headwinds in 2026. Labor market weakness. Early 2026 data shows slower payroll growth, rising jobless claims, and higher layoffs. A worsening labor market could dampen economic growth and negatively impact SCHD. Midterm elections. 2026 is a midterm year, which historically brings market volatility and policy uncertainty. SCHD's performance could be affected by political noise and shifts in congressional control. Despite recent challenges, SCHD has several strengths that investors shouldn't overlook. Consistent dividends, 14 consecutive years of dividend payments with a current yield of 3.3% paid quarterly. Dividend growth, 14 years of consecutive dividend growth with a 5-year annualized growth rate of 9.1%, helping hedge against inflation. Long-term performance. Over 10 years, SCHD has delivered returns exceeding 12.5% annually. Lower volatility, a 10-year beta of 0.86 and a 3-year beta of 0.71 versus the S&P 500, making it less volatile. Quality holdings. Strict selection process ensures high-quality dividend-paying companies. Low expenses, expense ratio of just 0.06%, costing roughly $6 per $10,000 invested. SCHD is ideal for investors seeking consistent dividend growth, those approaching or in retirement who want stable income, investors looking to diversify away from tech and growth stocks. SCHD may not be ideal for investors with long-term, high-risk tolerance seeking market-beating returns, those comparing all investments strictly against the S&P 500, investors needing high monthly income from high-yield sources. SCHD isn't perfect, but it's a strategic ETF built on a disciplined dividend growth approach. While it lagged in 2025 due to energy missteps, lack of tech exposure, and tariff-related sell-offs, early 2026 shows promise with strong sector performance and shifts in investor preferences. The March 2026 reconstitution will be pivotal, and broader market trends, interest rates, and political events will continue to shape its performance. Investors need to understand that SCHD is about the strategy, not chasing tech rallies or growth surges. With consistent dividends, quality holdings, low volatility, and a long-term track record, it remains a compelling option for conservative, income-focused portfolios. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.